Our next moderated panel is entitled Picking Up the Pieces from Crypto. And its moderator has spent his life leveraging dangers, seeking opportunities, and broadening prosperity. Ladies and gentlemen, may I introduce our moderator and panel, Michael Terpin, founder and CEO of Transform Ventures. Thank you.
Thank you. Delighted to be here. And we're going to have a very fast-moving 25-minute panel with a very distinguished and experienced panel of guests. And we're going to talk about picking up the pieces. So next May marks 10 years that I've been in crypto. And I got in at a moment when there was a huge crash. It had gone from an all-time high of $250 in March of 2013 to 120 at the very first Bitcoin conference, the Bitcoin Foundation conference. It kept going down to $66, and everybody was screaming, end of Bitcoin, end of Bitcoin. If you, like Dan Moorhead of Pantera, were savvy enough to go and pick up a few thousand Bitcoin at $66, you could have sold them for 1,000x return 8 years later. So we'll talk about more than just Bitcoin and crypto, but with the cloud of FTX hanging over the room and over the industry, we're going to obviously talk about that first. I'll start with letting the panelists introduce themselves. You see their company name there, and they will tell you what their Twitter handle is or how else to find out a little bit more and contact them. I'm Michael Terpin, and I'm at Michael Terpin on Twitter and pretty much everything else.
Thanks, Michael. Greg Dincelli from Scenius Capital. I co-founded and I'm a managing member at Scenius Capital. We're a digital asset investment firm focused on multi-manager strategies. We have a flagship fund of hedge funds launching a fund of venture capital funds, both exclusively focused on crypto, blockchain, Web3. You can find me at Gregory Dincelli, LinkedIn, and the Dinch on Twitter. And I am excited to see this room so full of attendees, and I'm based here in Miami.
Great. My name's Jeff Howard, and I run North America for a company called OSL. OSL is a publicly traded company on the Hong Kong Stock Exchange that effectively is just a crypto broker. So we have a brokerage business, a spot brokerage business. We have our own OSL exchange, which trades significant volume, custody, and then we have a SaaS business where effectively big clients such as Standard Chartered, they white label our exchange. So any institution or any bank that wants to really jumpstart and get their exchange up and running, they could white label our exchange. My background, I just 20 plus years on Wall Street, 5 or 6 years in the trading pits in Chicago. My background's fixed income, and so I look at fixed income markets as a way to kind of predict where risk assets are going to trade.
Hi, I'm Katie Talati. I'm the Director of Research at Arca. If you're not familiar with Arca, we are an investment management firm focused on giving sophisticated investors access to digital assets. So in my role, I oversee investment research across all of our funds, and mostly we focus on liquid tokens, NFTs, and venture capital.
I got it. Mike McGlone, Bloomberg Intelligence, macro strategist focusing on commodities and cryptos.
Great. Since everybody else said what they do, Transform Ventures is a venture studio, an incubator, accelerator. I also advise and market for a couple of hundred companies in the space going back to 2013, including launching Ethereum and Tether and a few other folks that got big. I've called the June gloom of the crash of Celsius and then Three Arrows Capital and some of the contagion effects that happened from that, plus Luna, the trilogy of terror. And of course that took the market from sitting very happily between 30 and 40 to going down as low as 17, which many people thought was going to be the low for Bitcoin. And as I like to say, just like they say the US dollar when the U.S. dollar catches a cold, the rest of the world catches pneumonia. When Bitcoin catches a cold, the rest of crypto catches pneumonia. And so now that we have FTX, the multi-headed beast that is FTX, Alameda, and Contagion, turning the trilogy of terror into the horsemen of the apocalypse, perhaps, I saw and I wish I remembered who had this poll up, but I saw it last week. Allegedly, there were, I think, 18 or 19 hedge fund managers, crypto hedge fund managers, and they asked what the price of Bitcoin was going to be in the coming months. Only one said it would go up, and they took a leap of faith to say it would go up to 17,000. We're at 16,500 right now, of course. 3 said it was going to 0. I don't know how you keep your job as a crypto hedge fund manager if you think it's going to 0. So I will ask everyone on the panel, A, what their personal experience has been, if any, with the four horsemen, and whether they think that this is going to collapse us below the historic bear market lows where we just happen to be at that part of the 4-year cycle, where we should get down to somewhere no lower than 11 or 12,000. Mike, you want to start?
Sure, happy to start. One thing I enjoy about these panels, first of all, I look at this room, I see a lot of people. That doesn't look like a bear market. Or are we the kind of people who really embrace bear markets as opportunities? And one thing I really enjoy is meeting my colleagues, and particularly Jeff. We used to work in the trading pits in Chicago. And that's the thing you learn in my 5 years I spent there, is about mitigating risk, taking risk, and managing leverage. And what happened with FTX and latest with BlockFi is just stuff we're used to. Always the same thing. Too much leverage, commingling funds, too much speculation, and idiots who don't understand mitigating risk and should have some adults in the space. Is there anything different? We've seen it before, but these things often carve out bottoms in markets. So what I see in cryptos as a commodity strategist, I see 2 key things from Bitcoin and Ethereum. Definable diminishing supply. I can't say that about any commodity on the planet. Look at crude oil, it's the same price as 2006. And increasing adoption and demand. Now that's decentralized markets, particularly Bitcoin and Ethereum. They're 70% of the Bloomberg Galaxy Crypto Index. And I look at this in the long term. Is that going to change? And I look at, well, you can't change code in defining diminishing supply, but you can change the adoption and demand. I only see that increasing, particularly now with what happened with FTX. This is going to bring in the regulators. Maybe they'll come out and say, okay, we do need that ETF that tracks a broad-based crypto index, like the SPY, Bloomberg Galaxy Crypto Index, so clients can go in and buy an index in a rational way, rather than picking winners with dicey ETFs that track futures, which have worked out in a positive way. So that's the way I see this space in the macro. And this is part of the bear market, but it's not crypto bear market, it's the macro bear market. Cryptos have been a rounding error this year in terms of decline, maybe $1 trillion. Google and Amazon alone have dropped together $1.4 trillion. Global equities have dropped $30 trillion. Global bonds have dropped maybe 5 times that. This is the Fed sledgehammer, pounding hard. Cryptos went up the most, they're going to go down the most, and they're going to come out ahead, I think, based on what I've said about declining supply, increasing demand. The question is, does the adoption stop? And I always like to point out the key thing to remember about Ethereum is it's like Jeff and I remember from futures. Futures changed the world in terms of investing and mitigating risk. ETFs have done the same thing. Cryptos are doing the same thing. What is Ethereum making happen? It's the most widely traded crypto on the planet. Ethereum are tokens that track the dollar. And the US isn't going to mess that up. At least I hope not. I mean, that's just silly to mess that up. So look at that, and then you look at Bitcoin. The world's going digital, as Mayor Suarez said, and Bitcoin is clearly becoming digital gold, and the world is going that way. So in the meantime, Bitcoin might get down to 10 to 12,000. It could, as the whole tide goes out, the Fed's tightening into a global recession. And then it should come back to do what it's been doing over history, and that's outperform most assets, Bitcoin and Ethereum. So with that, I pass it back to you.
Thank you for that analysis. It's been said that Bitcoin is digital gold and Ethereum is digital oil, because it actually does stuff. And after I get everybody else to talk about their personal experience with FTX and predictions, we'll then talk about some of the things, the markets that are not necessarily linked one-to-one to the price of Bitcoin and Ethereum, but they certainly use Ethereum. Without Ethereum, you would not have DeFi. Without Ethereum, you would not have NFTs. Without Ethereum, you would not have the decentralized part of the metaverse. So let's move on down the panel and talk about FTX.
Yeah. I mean, in terms of what I think we just saw happen, for most people, even in the industry who are very seasoned, like, it was a shock. You know, I was around during the last bear market, also working at Arca, and like the day we saw FTX become insolvent, we were like, wow, like this was not on our bingo card. You know, but also I think a lot of what happened this year has been the result of kind of additional money in the space and a lot of overexuberance at the end of the day. And unfortunately, also a lack of regulation. I think if regulators had been a little bit more aggressive, especially in the United States, had come in a year or two ago and said, hey, like, if you're going to run an exchange, you have to, you know, you're going to have to do X, Y, and Z.
But of course, they were not a U.S. exchange, and it's been said by many people that the lack of clarity around regulation is what's been driving 95% of the exchanges offshore, where arguably you have less control over them.
That is also true, but the FTX US exchange was also equally hit in this, and that was supposedly a regulated exchange, you know, based in the United States. And I think, in general, it's not just the exchanges; it's any crypto project. Most of them have had to reincorporate overseas. They've left the U.S. They're, you know, either seeking out headquarters in Latin America, Asia, Europe. Almost all of them, there is some sort of regulatory framework that exists there. I think specifically, though, if we had been a bit more aggressive about giving companies a framework a while ago, it would be a lot easier for the regular consumer and even sophisticated investors to weed out who was actually, you know, a good exchange or who was, you know, a bad actor.
And I guess I don't want to spend too much time on this, but you do have regulated exchanges in the United States, have been around for a while. You know, Paxos, Coinbase, Gemini. Are they going to be the survivors? Or are they going to be sort of questioned with the same process that you're all FTX?
Well, I would say they're not really regulated in the extent that they should be. I mean, Coinbase, they're regulated because they're publicly listed now, so they have to share their financials. They have to have audits. You know, Gemini, I know, is incorporated in New York, which has the BIT license requirement. It's much more stringent. But even the BIT license requirement, many have said, is like way too onerous. I think, you know, there's no clear regulation that says, you know, hey, exchanges have to do this. They have to separate these types of businesses. They need to, you know, show their assets and liabilities regularly. And as a result, we don't have consumer protections, even here in the U.S.
And your take on this as sort of the more macro guy.
Yeah, so I think we can all agree that, you know, the collapse of FTX, you know, just created a shit show for the whole entire market. You know, you can't regulate fraud, and I'll get to that in a second. But so this year, I think there's been the two main shocks that have hit the system. It was in May and June with the Terra Luna. Ultimately, 3AC and a few others went down. I view that different than what's going on with FTX. Effectively, coming from a fixed income background, I mean, this is the year of the crypto unwind. It's an unwind of leverage, and it's an unwind of confidence. The leverage is getting unwound, not on purpose. People don't want to let their leverage go. It's because of interest rates. It's plain and simple. Crypto's been operating for like the last 13 years, 2009, however many years, in an environment, in a QE, a quantitative easing environment across the entire globe. Every single central bank has been has very loose money and low interest rates. That obviously, the money's got to go somewhere, right? So the money goes to VCs. The VCs invest in crypto projects. It goes into crypto, you know, lenders, and so forth. And so in May and June, because interest rates started to rise for the first time in 13 years, it exposed who was over levered, right? And so any crypto lender that's lending somewhere upwards of 18% when real interest rates are zero, I mean, to me, that's ultimately that's a Ponzi scheme, first of all, and it's ultimately gonna get washed out when the market, you know, sniffs you out. So interest rates are dependent on where crypto goes, or crypto's dependent on interest rates. FTX is a fraud. We all know that. Sam Bankman fraud. He did everything he said he wasn't going to do. You know, it's a terrible thing what happened in the market. The upside, and I'll stop. The upside is we got some of the bad actors out of the way. Crypto's not going anywhere. Digital assets are not going anywhere. Bitcoin, ETH, obviously not going anywhere. So got some of the over-levered players and then fraud out of the system. And I think we're coming to the end of the interest rate rising cycle. You know, they've gone up from 0 to 4%. I think they probably have 50 to 75 more basis points. And then I think you see risk assets starting to trade higher, including crypto. And I think getting the over-levered players out of the system is great. Any lender that still exists right now that hasn't filed for bankruptcy is basically a zombie company, right? There's just, the leverage is gone, and it's gone because of higher
including
interest rates.
BlockFi yesterday, and I thought that was going to like tank the market again, and it didn't. I think there's not too many more people left to sell who are dependent on the daily news cycle of who's going bankrupt associated with FTX.
Yeah, you know, I mean, you know, what I find interesting is crypto hasn't really had a contagion problem outside of crypto, right? And you know, everyone thought FTX was going to go down. The next day, stocks rallied 1,000 points. They had their best day since June of 2022. The day after FTX, you know, announced their problems, and so I think it's because crypto now for institutions is very small. As of September, I think you know, what classifies as an institutional investor only had $9 billion worth of crypto. That's it. So crypto for the other financial industry is very small. I mean, it was small when it was when the whole industry was 3 trillion valuation, and now it's what, under a trillion. So it's a very small.
So the $9 billion that institutions have in the entire globe in crypto is roughly equal to the amount of customer assets that Mr. Fraud basically loaned over to Alameda. Yep. One company. Gregory.
No, so I echo everything that my co-panelists have said. I think there's 2 points that I would make, maybe, that I think are worth mentioning. One is centralized exchange, you know, centralized entities being the culprits in what we've seen unravel here with 3AC and Celsius, the BlockFis, and now, of course, FTX. And then is FTX a catalyst that helps sort of move the industry forward in some meaningful ways? So on the first piece, what we've seen is essentially centralized, opaque entities that you know, don't provide regular audits, don't provide transparency into their operations, don't follow proper risk controls, essentially, you know, taking customer assets and, you know, leverage long, risky strategies, and you know, compromising all risk management in the process, and that's led to blow-ups and massive liquidations and huge deleveraging events. That, I think, is one problem that we can expect to be addressed relatively promptly, but needs to be, you know, distinguished from decentralized entities and sort of the real underlying thesis of what blockchain technology is intended to solve for, which is, you know, decentralized, trustless, non-custodial, self-sovereign assets and the ability to transact and create value. So that's very important. And so far, DeFi has worked, right? The battle-tested protocols, the Aave, the Uniswaps, the Compounds of the world continue to work. They're programmable, autonomous code on, you know, layer 1 smart contract blockchain.
And we took 100,000 Bitcoin in a week after FTX went down, and they on-chain moved from centralized, you know, outbox wallets into private, you know, treasures and ledgers, largely under 10 Bitcoin in total holdings, in many cases under 1 Bitcoin.
You're saying that they can be moved, or
no? I'm saying they moved.
Yeah.
The consumers, the people who are, you know, the retail investors, you know, who didn't panic sell, basically just calmly took their money out of the centralized exchanges from Coinbase on down, and so we don't trust you anymore. We're not going to keep our assets unless we're trading that day. And 100,000 Bitcoin moved like in a couple of days. Yeah. Over to private wallets.
Not your keys, not your coin.
Right.
That's always been the case and continues to be the case. And if you're entrusting your private keys to someone else, those coins are at risk. And then the other point I was going to make quickly is just, you know, JP Morgan published a note on FTX potentially being a catalyst in the sense of taking one giant step back to potentially take two meaningful steps forward. And what that hopefully is pulling forward meaningful regulation to ensure investor protections. That's the hope in order to get institutional adoption at scale. And I think that's what you need, particularly in the centralized arena. I'm hopeful that we're going to start to see that happen. We see the House set a hearing. We have Senator Loomis who's attending. They're having a hearing, I think, on December 13th. So we need this type of
And I
regulation.
think we have about 5 minutes before Senator Loomis comes up. So I've got sort of a shorter question, and there's a question that will require shorter answers. In the introduction, we talked about how everything's not just the price of Bitcoin, it's also this nascent world of Web3, including NFTs and DeFi. And Mike, you had mentioned that this is sort of a unique commodities class where it's got definable, sort of like rising adoption and diminishing supply each year. It's also unique in the fact that this is a commodity, group of commodities that will create other commodities, everything that came as tokens that then had their own market cap, built on top of some of the other commodities that are the layer ones, and also spinning off equity opportunities. There's certainly billions of dollars of companies that are Delaware C Corps in the space, and they're not all exchanges. And then also, I guess, collectibles for the size of the NFT market. So this is also unique. I'm certainly finding in the last couple months deals at prices I never thought I'd see again. And so as an investor, when you see someone who last year was asking for $10 million on a $100 million market cap without shipping their first product, is now coming and they actually have the product and they're asking for a $250,000 bridge on a $5 million round, I think that means some of the excess has been shaken out. And the people who aren't doing that are basically saying, how do I pivot to Web 2? And so I would like everybody's quick thoughts on sort of what this means about the future of companies in the space going forward.
Well, in our minimum time, I'll keep it brief. I look at it very simplistically as things like Jeff and I remember. The trading pits just went poof, and they were gone. Rapidly advancing technology. I think everybody in this room, you got to embrace it. Why take the risk? I used to be a voice broker in New York. Poof, the business is gone. And why? Because of technology. So look at the tokenization of assets. Tokenization is the dollar. This space chose the dollar its base layer. The US is not going to mess that up. What's next? Tokenization of all assets. Yes, there's going to be pushback because from the incumbents, but to me, what stops it? It's a better technology. MasterCard and Visa have adopted crypto dollars. I have to call them crypto dollars because they're not. People call them stable coins, but they're all dollars. And to me, the question is, what stops this? And what person who sees what happened to Blockbuster and Sears and what's happening to Amazon right now says, well, I'm not going to get involved. You have to have some institutional exposure versus the risk 10 years from now that you're not involved. That's the way I look at it. To me, the risk of a 1% allocation for an institution is much less than 0 5 to 10 years from now. Back to you.
Yeah, I mean, look, I would say, kind of to your point, Mike, I think one issue the space has, and we still have, is that we are not very approachable from an education standpoint. I assume everybody was just at Thanksgiving with a family member who was like, well, how about crypto? And it's all a Ponzi scheme and it's all fraud. And I literally had to sit there this year and explain what was Bitcoin, why was it different from FTX, why that wasn't a Ponzi scheme, but maybe this was a problem. And I think that's something we really need to work on going forward. To your point, though, about deals, Michael, I would say that, at least from what I've seen in the last 6 months, the kind of the venture capital scene, not just in crypto, but very broadly, was really overinflated. And I think that was a result of, the global macro conditions, basically low interest rates. A lot of these larger institutional investors needed to hit certain return targets. And so what they did is they expanded their risk profile, investing more heavily in larger, later stage VC funds that promised these giant returns. With all that money pouring into the space, that's where we saw these inflated valuations come from. And it wasn't just in crypto, it was all across any early stage or even later stage private investments.
Yeah, I totally agree. It's all about interest rates. So I think new startups and Series A guys looking to raise money, I think it's going to be tight for a while. VCs got burned. The best VCs in the world allegedly, got burned by FTX. And so they're going to be cautious until they feel that obviously the market is stabilized, but then also that we're at the end of the interest rate hike cycle. For me, I just trade, and so what's always kind of worked for me is when the sentiment is the worst it possibly is. Everyone's thinks the market's crap and everyone's negative, everyone you talk to, that to me is an absolute buy opportunity. So I'm a buyer. I would be a buyer of some of the early stage VC that actually made sense. I'm a buyer of crypto at these, or Bitcoin at these levels, because sentiment just could not be worse. I love it when sentiment is bad.
Yeah, and to the point, I would just say, I think that during the crypto winter, bear market, whatever you want to call it, you're going to have a focus on building quality. People will put their heads down and build quality products, which creates an attractive environment for allocators. And I think those companies that build the quality products are going to have, you know, a premium going forward when money starts to be distributed to the best-in-class developers and builders in the space, and we're still seeing great things being built.
And that's a wrap. We've got 10 seconds left. I'd like to thank Kyle and the whole Miamiweb3 team for this awesome, first-year show. And, I'll be around the next 2 days. I think a lot of the panelists will as well, and you've got everybody's contact information. Thank you very much.